Well, let's get some more on that result and the rest of the day's trade. We're joined by Christine Ip from Bell Direct. Christine, great to have your company. Thanks for joining us. Those Woolworths shares up over 1% at the moment, despite that drop in profits that we have seen. What did you make of the result?
I guess it was no surprise given the profit warnings. A surprising lift in the share price today, like you mentioned, after the Woolworths reported a 12.5% slump in full-year net profit. Revenue was down 0.1% and sales growth for its food, liquor and petrol businesses barely improved above 2%. And that also resulted in a credit rating cut from Standard & Poor's. Now, while Woolworths' position as Australia's largest supermarket gives it buying advantage and economies of scale, it is still losing market share to the likes of Coles, Aldi and Costco. Now, investors will be happy the company is keeping its dividend the same, with a final dividend announced at 72 cents a share, fully franked. And shares are up today, I think, mostly also due to the announcement of its new chief executive, Gordon Keynes. Now, that appointment is going to be a key turning point in the struggling supermarket group. And there's not much to fault with the new executive. And he's turned around David Jones and sits on the board of Macquarie Group. Investors are also recognising that dip in profit was predominantly weighed down by one-off charges to do with redundancy costs and restructures. Another positive takeaway from the result was the cost-cutting efforts with the job cuts. And the CEO has also announced the cost-cutting is ahead of projection. So it was a disappointing result, but that was expected thanks to profit warnings prior. And this could be a huge turnaround point for the company that's really been plagued with poor management. There's still a lot of benefits to holding Woolworths shares. So despite that disappointing results, we are seeing Woolworths shares up above 1% today.
On the flip side, Christine, Regis Healthcare, another one in focus, we're seeing those shares at the moment down about 5.6%, although it looked like it posted a pretty strong result. So why are we seeing those shares down today?
Well, the healthcare sector in this reporting season has been closely watched. It was a very strong result for Regis, which is going to delight shareholders who participated in its ASX listing last year. A statutory net profit of $57.5 million, up from $1.1 million the previous year. A fantastic result. Revenue was up 7%, and the company will pay a final dividend of 17.6 cents a share. Now, shares first listed on the ASX at $3.65 in an overwhelming book build last year. We're seeing shares currently at $5.85. There have been solid fundamentals that continue to fuel demand for the healthcare sector, namely Australia's growing population. And we've seen key healthcare participants like CSL, Ramsay and Cochlear all performing well this year. So investors have been betting big on the healthcare sector. We've seen strong demand in this industry, and if anything, there has been a shortage of services. The falling Aussie dollar and the positive US recovery has been great for these companies as well. So those huge expectations going into earnings season, all that hype. So we've seen some of these healthcare players pull back a bit despite those robust results. Now, they are still up between 20 to 30% in the last 9 months and outperforming the overall market. So we've seen this pullback happen to Japara Healthcare, which announced a better than expected lift in revenue, and we saw its shares fall 3% after the announcement. Estia Health was another one. Its earnings topped forecast with $44.6 million in net profit, and its dividend was also ahead of forecast as well, but its shares were up just 0.3% after the announcement. Ramsay Healthcare was the exception yesterday, but their outlook for the new year was weaker than expected, and that could also be what's weighing on Regis Healthcare, which despite a huge result, shares are down almost 5% today after a couple of huge gains in the share price this week.
Christine, very much earnings in focus once again today, but in other news, Telstra is actually confirming another joint venture in Asia. Looks like those shares are actually slightly lower. Take us through the details of this one.
Investors may be a little bit wary about the company spending more cash. Now, Telstra have confirmed they're in discussions with the San Miguel Corporation in the Philippines for a joint venture in mobile services. Now, we only know so far that financing has been sought, so that's been confirmed by Telstra, but the deal is rumoured to be worth hundreds of millions of dollars. Now, most of us know San Miguel as a beer company, but what we might not know is that it's moving to be a major mobile operator in its home country of the Philippines. It will be the country's country's fourth largest mobile operator when it launches Bell Communications next January. Bell Telecommunications, when it launches, is going to be up against two telco operators who have long dominated the Philippines' mobile industry. And because San Miguel have already expended considerable capital on acquisition and construction, they will welcome an experienced partner with the cash to tap into an industry with well over 100 million subscribers. Now, that rise in social media has left room for enormous expansion in services and internet usage in Asia, and also in a country that's currently lagging behind in mobile internet services. Now, Telstra have said no agreements have been reached so far, but the deal will be another footprint in its strategy to co-fund the 4G networks across Australia, the last deal being Telecom Indonesia, and furthering that expansion into Asia is going to be a positive for the telco, which has seen the NBN and competition erode its domestic earnings. But shares are down today because there is still a lot of unknowns in the deal, and shareholders perhaps questioning the large amount of cash that the company is spending into acquisitions and deals, and that may threaten dividend growth. So we're seeing its shares down over 1% today.
Fantastic, Christine. Really appreciate your time. Thanks for joining us.
Thanks, Leanne.